Okay, so we are welcoming everyone to our final academic session, which is session 6. This session on ESG rating issues in equity markets. My name is Michael King. I'm here at UVic. I'm going to pass the floor to Aleksandra RZEZNIK, who will be followed by the discussant Vikas MEHROTRA. Aleksandra, you've got 15 minutes and Vikas 10 minutes. Go ahead.
Thank you so much. I really appreciate for accepting our paper to this conference. So this is joint work with Kathleen and Loriana. So it's a very female group, as you can see. And what we're trying to investigate in this paper is whether ESG ratings are important for the investors, or maybe sometimes they are confusing. And we're going to argue that unfortunately they are confusing. So this is the result of our paper on the first slide, which at the first glance might not look shocking, because what you can see here on the left axis is the change in abnormal return. On the x-axis, you can see the change in the ESG rating. So you can see wherever the ESG rating increases, you would think, right, that the company becomes more friendly, sustainability, ESG friendly, investors appreciate it, and that's why a company experiences a positive abnormal return. But this is not exactly what's going on here, because the change in the ESG is kind of like a pseudo change. What we're exploring in this paper is a methodology change. So the change in ESG, we're going to argue, has nothing to do with the information or the cash flow. The only thing that changes, or we want to argue that the only thing that changes is the scale. So the scale got inverted. So literally the results should go the other way around, because now the companies that had high rating before, they will have low rating now, scale got inverted, and the companies that have a low rating before will have a high rating now. We think that ratings are generally important, right? Because we remember the company ratings in terms of credit ratings. So the rating agencies play a very important role of being a middleman. And they are supposed to gather information, process them, distribute them in order to make people's life easier, in order so that they can invest in the assets. So there are two roles that those rating agencies are supposed to do: provide information, and once they provide information, this can affect the preferences of investors. But the problem is that it might be the case, what we're exploring, that the ratings are not going to show the information. There might be just a change in the rating that is not going to be correlated to any new information or any cash flow information when it comes to the company. In that situation, we would expect that investors are not going to respond to this change in the ratings. And this change in the ratings by itself, without any information regarding the company, allows us to identify whether ESG ratings have any power on the investors or not. Otherwise, it's a little bit contaminated. We do not know whether investors respond to the changes in the ratings, or do they respond to the information about the cash flow of the company, or whether they respond to the fundamentals. This setup that we are going to use in our paper allows us to disentangle those two things. As I already mentioned, we're going to explore a natural experiment that inverted the scale, and that's why it also inverted the interpretation of the ESG ratings. And we are going to look how the returns reacted to this change in the scale, and also how investors respond to the change in the ratings. So the change in the methodology comes from Morningstar, Yahoo Finance, and Sustainalytics. Sustainalytics is one of the main providers of sustainability ratings in the world, and it started providing its ratings already in March 2016. 2 years later, Yahoo Finance got a deal, or started providing ESG rating from Sustainalytics for free to the investors on their website. In the meantime, Sustainalytics was working very hard in order to improve the ESG rating. And in September 2018, Sustainalytics came with the new ESG risk rating. So now they are going to express the ESG rating in terms of risk instead of just the higher number, the better. A year later, Yahoo Finance and Morningstar adopted the new Sustainalytics ESG risk rating. And this is exactly what we're going to explore. We're going to explore the period around October 2019, where Yahoo Finance and Morningstar just changed ESG rating to ESG risk rating. Just because I like procrastinating, so you will see a lot of different diagrams. So just to explain once again how the rating inversion worked. Before we had the ESG rating, and the ESG rating, the scale was between 0 and 100. And the idea was that the higher the number, the more ESG friendly the company is. Then the Sustainalytics changed the ESG rating to ESG risk rating. And now the higher the number, it means that there is more ESG risk in the company. So now the company, in order to be ESG friendly, want to have the lower possible ESG risk. So the more ESG friendly company has low ESG risk rating. So this is where the inversion of the scale shows up. And what I want to show you is how, I would say, random the change in the ESG rating was. So for example, you can see Microsoft. Microsoft is one of the leaders in the sustainability, at least in our data set. So you can see that before, Microsoft had a very high ESG rating. It means that it was very ESG friendly. And after the change of the methodology, it has very, very low ESG risk. So you can see that the change in the perceived ESG rating is very negative. So you can see that for uninformed investors, Microsoft would experience a pseudo ESG downgrade. On the other hand, when we look, for example, at Earthstone Energy, it had in the mid values ESG rating before the regulation methodology change, and then very high risk rating. So this would be perceived by uninformed investor as a ESG upgrade. And this just to show you how the distribution of the changes look like. So they are pretty nicely distributed so that there is nothing funky that we are capturing in our regression. The two vertical orange lines indicate our two dummy variables that we are going to use later on. One dummy variable is a pseudo downgrade, which consists of 25% of the companies with the largest pseudo downgrade, with the most negative change in the ESG rating. And then the second vertical line tells us which companies belong to the pseudo upgrade companies, which experience a positive change in the ESG rating. And so that you know, there's only around 6% of the companies that has a positive change. So that's why it's not symmetrical how we build those dummy variables. So this is our first result. What we are going to use, we are using generalized diff and diff regression. Generalized because we have exposure to the treatment, which is the change in the ESG rating. We control for stock fixed effects and time fixed effect, year-month fixed effect. In still working results, we also include industry times year-month fixed effect, and our results still hold. So this is our main result of the paper. So you can see that the more the change was negative, meaning that company was very environmentally friendly from the beginning, had very high ESG rating before, and then still was very environmentally friendly, meaning had very low ESG rating after, those companies are going to, so this is right negative change. So those companies are going to experience very negative abnormal returns. On the other hand, right, if the company was very ESG unfriendly, meaning that it had very low ESG rating before and very high ESG risk rating after, those companies experience very high abnormal returns. So this is right shocking, because that doesn't really make sense. And it looks like that investors confuse the change in the ESG rating with real information being disseminated by the rating company. In order to capture differential effects, we also add two dummy variables for pseudo downgrade and pseudo upgrade. In that case, we are comparing the abnormal returns to the omitted group, which is a group of stocks that only experience very moderate changes in the ESG rating. And you can see that the companies that got pseudo downgraded, they experience significant negative return, abnormal return, and the companies that got pseudo upgraded, they experience a positive abnormal return. And here what we are trying to see is how long this effect lasts. So what we're doing, we are using a dynamic diff and diff setup where we are regressing the abnormal return on every month interacted with a dummy variable of pseudo downgrade. And our reference month is the last month before the new regulation, new methodology introduction, which is September 2019. And you can see that while before the methodology, there is no change in the abnormal returns between pseudo downgraded companies and the others. After the methodology, those pseudo downgraded companies underperform significantly. And then they start performing again back in February 2020. So the second question is, who drives this? How does it happen? And that's why we're going to look at 4 different types of investors. We're looking at retail investors by using Robinhood dataset, where we see the popularity or participation of the retail investors in a given stock. We look at more informed investors, which are 13F institutions, or ESG mutual funds. So those are the funds that really are focused on ESG investment. And then we also look at short sellers that are supposed to be the most clever ones, probably taking advantage of this mispricing. So what we have here, we again use a different setup, but we already difference our variables in the first step. So we look at the change in the ownership of the retail investor, 13F, ESG funds, and short sellers. And again, probably not shocking is that those investors that are perceived uninformed or less able to process information, retail investors, those are the investors that make the mistake. So retail investors, those are the ones that are buying the stocks that got pseudo upgraded, and they are selling the stocks that became pseudo downgraded. And 13F institutions or ESG funds, they don't respond at all. They seem to either have access to the ratings already before, right? Because the sustainability ratings, risk ratings were already available since September 2018, or they are just able to read the information that Morningstar sends them, and were able to understand that this is just only change of the scale, and this is not no new information. And short sellers, as probably expected, they are going to be the clever ones, and they are going to take advantage of uninformedness of the retail investors. So they are going to increase the short interest for the stocks that experience a pseudo upgrade, and they are going to decrease short interest for the stocks that experience pseudo downgrade. My co-authors hate my diagrams, but they are not here, so I'm going to show you some more of my diagrams.
Okay, last minute, yeah.
One last minute, okay.
Yeah, last minute.
Last minute. So there's a lot of different sources of information. It might be there was an oil spill, or it might be that, so this is here, we have the oil spill, and then we have another source of information, which is that now the new methodology includes more of the inputs. So we want to control for that, and we do it by using Sustainalytics rating. So Sustainalytics rating is going to control for an oil spill that happened over September. Or we also add an ESG rank, which tells us how relatively companies' sustainability compares to other companies in a given period. Including them does not change our result. And we have a lot of other a lot, I would say now even more robustness check. The last thing I have to say, because it's one of my very favorite tables and I never managed to talk about it, this is just a triple interaction heterogeneity analysis. We show that stocks that are more visible or more likely to be held by institutional investors, they are less affected by the methodology change. So overall, we want to say that ESG ratings are very important, but they are important in such a way that people have to understand them. Otherwise, they might backfire. Thank you.
Okay, thank you, Aleksandra, and over to you, Vikas.
Thank you very much. Perfect. So this paper, I really enjoyed reading this paper. It's extremely well written. I was telling Aleksandra just a minute before, during the break. By the time you come to the last table, table 7, there is no doubt that retail investors were more than a little cognitively challenged when Sustainalytics revamped their ESG metrics. I would change potentially confused. I would say, please let the evidence show that retail investors were confused beyond a shadow of doubt. In fact, short sellers knowingly took full advantage of my clients, and the defense rests. So what happened? A quick recap. Sustainalytics introduced these new ESG ratings in September 18. The old ratings went from 0 to 100, and the higher your score was, the more superior your ESG class was. And the new ratings inverted this, and the lower your scores were, the more superior ESG class was. Consequences of this confusion among retail investors, especially the Robinhood crowd. I'll come back to this later on, because we see from their actions they sell the low scoring firms under the mistaken belief that such firms represent the poor ESG performers, and vice versa as well. Short sellers predicted the confusion and sold strong ESG firms. This kind of implies that Robinhood investors are cognitively challenged. And this is not that far-fetched. This is consistent with a paper by Dechev in 2007, who shows that investor returns consistently lagged security returns by 1.3% per year for NYSE listed stocks, and by more than 5% per year for NASDAQ stocks. The rest of this paper, 3 main findings. The new ESG rating scheme was beyond the processing capacity of retail investors. They buy on pseudo upgrades and consistently sell on pseudo downgrades. Number 2, short-term price pressure pulls up prices for pseudo upgraders and pushes prices down for pseudo downgraders, and that the price pressure itself is short-lived. There is less confusion among 13G investors, and short sellers make hay. Is this kind of an investor confusion surprising? I don't think so. This is a quick graph I found in recent, this is a company called Long Island Tea. They decided there's not much money in tea, so they changed their name to Long Island, just Long Blockchain. And when they did that, the price goes from $2 to $7. The SEC got wind of them and shut them down. Here's another one. This is, do investors value sustainability? 3 years ago, the Wall Street Journal did a deep analysis of this. As you go up on this graph, you get higher star ratings. And as you go right, you get higher performance. And what the Wall Street Journal found is that investors pour money into top-rated funds, even when their performance declines. And vice versa as well. Investors consistently pull money from low-rated funds, even if their performance improves. So there we go. This is kind of like your Robinhood retail investor crowd here. Understanding price pressure when the rating system changes. Here, what we have here are three possibilities. You have the investor, like the 13F or the ESG funds. You have investors in the retail group and short sellers. And then there are two possibilities for each investor group. They either care about ESG or they don't care about ESG. And if you look at 13F investors, then in both instances, whether or not they care about ESG, there is no price pressure. But if you look at the second group, the retail investors, if they do care about ESG, then they will load up on the pseudo operators, and they will sell on the pseudo downgrades. So there will be temporary price pressure, and we will talk a bit more about this. The price pressure in turn will depend on the demand elasticity for these stocks, which I think the authors could exploit a bit more. And the short sellers are just opportunistic. They're just waiting to take advantage of price pressure. Finally, in terms of mean reversion, this is something I would like to talk about a little bit, because on page 16, the authors say that firms below the diagonal improve their ranking, and firms above the diagonal worsen their ranking. And those on the diagonal do not change their classification at all. Now, this kind of seems to me that there is some mean reversion going on here. This is consistent with another piece done in the Wall Street Journal that talked about what happens to companies that get the highest 5 globe ratings from Morningstar. And they found that the best prediction of where these companies will be in less than a year's time is a 3 globe rating. And vice versa. If you're a 1 globe rater, then your best prediction where you'll be a year later is 3 globes. So there's tremendous mean reversion in climate, in ESG ratings. How does the presence of this mean reversion affect these studies' inferences? The Morningstar 5 globe system, as I mentioned earlier, is sort of prone to mean reversion. Are short sellers targeting naive retailers, or are they simply basing their short sales on knowing that there will be a strong tendency for mean reversion? Finally, I think a few other things. Let me see if I have, how much time do I have? I have 2 minutes.
Yep.
Okay, then I would like to talk a little bit about what do we learn from this study. And here, when they believe the ESG ratings have worsened, as we pointed out, retail investors bolt. Does it mean they actually care about ESG or its components such as climate? The conclusion in this study believes that they do. Investor preference for sustainable assets and their reliance on ESG ratings for making investment decisions can have pricing implications. So I put in bold investor preference for sustainable assets. Is this the only possibility? I think the answer depends on what each investor thinks, how the other investors will behave. Sort of like Keynes' stock market as a beauty contest. So for those of you who are not aware of this, a little Keynes' idea of how the stock market works, the task here is to pick the 4 most beautiful people, and the objective is to pick the most popular 4 that win the contest. So if I were to pick, I would pick these 4, and that would be a very naive strategy. So if I really want to win, I have to then think about the next level of rationality, what other people will. Suppose I think that the other people will pick these 4. Then I will change my picks in response to what I think other people will think. And then this game can go ad nauseum. I can have a second, third, fourth, fifth levels of rationality and so on. So it is possible that investors don't care about ESG as much as they think other investors care about ESG. And therefore, they jump in anytime they see a tick or a change in the ESG scores. That's a possibility one should at least entertain. We talked about this.
Yeah, if you could wrap up, please.
So I already I skipped the first middle slides, and I already done my conclusion. So as I said at the beginning, it's a very convincing paper, and I enjoyed reading it, and I look forward to it appearing in print at a good journal. Thank you.
Thank you very much, Vikas. I'm looking for a show of hands, and I'll give just a momentary pause. And if there's no show of hands, I will allow Aleksandra to respond. Aleksandra, I would recommend that you look into the ratings, inflation ratings shopping literature, an older literature about credit rating changes. Moody's added modifiers to the ratings with no change in the underlying fundamentals, and you can look at what the stock market reaction to that was. It's a related literature looking at credit ratings, and I can follow up with some citations for you on that. Okay, over to you, Aleksandra.
So thank you for the credit rating literature. Like, we for sure cite one paper that look at the changes, I think, in so this is my co-author put the citation because Loriana is very much into credit ratings and just credit risk. But we do refer to one of the papers that we kind of show a similar result, that even though in the absence of the fundamental changes, there is an investor's reaction to the changes in the rating. So in that sense, we do know that this is not new result. What we want to show is that there is such a big hype, especially in Europe, when it comes to ESG. If you go to the store, everything is ESG, everything is sustainable. And it's very important to be very precise to be what sustainable is, or very transparent. So I would like to thank you so much for the great discussion. I love the idea about the mean reversion. We did not think about that at all, that we had to somehow think how we can control for that, or how we can test for that, that that the short sellers, they respond to the change in the methodology, or whether they just whether they try to bet on the mean reversion. So that's a very interesting point. When it comes to higher degree of rationality, it's also very thought-provoking idea, I have to say. Not sure how we could test it when it comes to retail investors, but I could think from the mutual fund literature, I could think a little bit more in terms of herding, right? That would be, I'm just buying something that I know other people are buying, or they bought before me, right? They would be just picking those stocks that I think other people also find attractive. That's why I'm buying it. So I for sure will, I'm not sure how I can introduce it for the retail investors, but we might want to look at mutual funds because the test is going to be significantly easier for us. But those were great comments. Thank you so much.
So one quick thing, if you want to look at something, look at the subreddit group, such as Wall Street Bets or something. That's where the Robinhood crowd congregates.
Okay, great.
And so if you're going to see, trading based on rumors and so on, you might find it in the subreddit groups.
Okay, thank you.
So we're gonna do meme stocks with ESG ratings is what Vikas is suggesting. Okay, thank you. Our next presenter is John Kim. John is joining us from Atlanta. Take it away, John.
Can you see my screen?
Yes. Perfect.
Okay. So thank you so much to the conference organizers for having this paper on the program. I'm really excited to be here. This is a joint work with Sudheer CHAVA at Georgia Tech and with Jaemin, who was a PhD student at Emory. So I want to begin with the fact that investors care about sustainability. I guess this requires less of a convincing in this particular audience, but just to give a few examples, I mean, we know that global assets that consider ESG factors when making portfolio choice have grown from about 23 trillion US dollars in 2016 to about 31 trillion US dollars in 2018, which is an incredible growth of about 50% in assets over the span of 2 years. And we know this trend is ongoing. During the COVID-19 pandemic of last year, ESG funds have actually attracted record inflows, during which period of time, a lot of other types of funds have actually experienced significant outflows. So this naturally raises the questions of why investors actually care about sustainability. Obviously, the standard economic dichotomy would suggest this pays off, right? I mean, perhaps you get something good in terms of risk or return. The alternative is investors experience sufficient non-pecuniary benefits or happiness from investing in the right people. So we're trying to contribute to this old debate of, can we justify ESG investments based on risk return considerations? And to do so, we're going to focus specifically on the systematic downside risk. So to motivate the hypothesis, I want to begin with the quote from Benabou and Tirole 2010, who argued that corporate social responsibility is really about taking a long-term perspective to maximizing intertemporal profits. And I think typically when we talk about the value of ESG or CSR, you usually hear one variant of these types of examples. Firm is thinking about economizing on safety or pollution control. So this is an example of an E or environment. And to the extent that the firm's able to economize the cost right now, this would presumably lead to higher profits in the short run. But this could also expose the firm to contingent liabilities, like there comes about a new regulations that require the firm to overhaul the production process that is polluting, or the firm might experience some type of polluting accident that's going to require significant environmental cleanup costs. And we're going to hypothesize that such risks would be systematic to the extent that many firms typically suffer from managerial myopia or care a lot about the short run stuff. And of course, when such risks materialize, high CSR firms, or in this particular example, environmentally friendly firms, would perform better. And also on top of this, we know that a lot of the examples of the benefits of CSR tend to accrue in the downside or the bad scenario. So given these two facts, we hypothesize perhaps the key benefit of investing in ESG firms really is about having a lower systematic downside risk. Of course, we cannot rule out just generally stronger financial performance, and indeed, we will also consider that. So in this paper, we empirically analyzed the implications of a firm's ES ratings on its future stock returns, for which we don't find much of a meaningful relationship. I think this is consistent with the previous literature, which finds results spanning from outperformance all the way to underperformance. Also, with future exposure to unconditional market risk, we're going to find that we find some evidence, but ultimately it's going to be statistically insignificant once we control for the strong autocorrelation in the regular market beta. Where we do find some significant results is when we look at the future exposure to downside risk. We do find that firms with high ES ratings have statistically significantly lower downside risk than those that don't. But the unfortunate thing is, when we think hard about the economic magnitude of this decrease, it's very hard to make an argument that this is materially important. I won't have time to go over these results, but we also analyzed the implications of ES ratings on realized firm use sentiment and the institutional trading patterns. And we're going to find results that essentially mimic what we find using the stock return data. So taken together, I think our results are highlighting that the key pecuniary benefit of investing based on ES factors must be relying on the reduction of systematic downside risk, but ultimately it's hard to make an argument that this is economically meaningful. And overall, we believe that our evidence is consistent with the key role of non-pecuniary motives playing, in explaining the recent growth of ES investings. together with the fact that there's no cost to this and no pecuniary cost to this. I'm going to skip the literature review in the interest of time, but I'd be happy to talk about it if anybody has questions about it. So to do the analysis, we need to define two things: the firm's ES performance and the firm's downside risk measure. We're going to rely on the KLD database, which classifies ESG performance into 13 granular categories. We're going to rely on the first 6 in this list: environment for E, and then community through product for S. And we're going to be focusing on the implications of ES ratings within a given industry. So we're not going to worry ourselves with the industry related categories, basically the SIN categories. For each of the 6 categories we consider, we're going to construct a net ES measure within that category. That's going to range from -1 to +1. We're going to add across the 6 categories that we look at. This is going to give our main proxy for ES performance of a firm. That's going to range from -6 to +6. To define downside risk measure, we consider various measures in the paper. Let me begin with the unconditional market beta. In month T, we're going to use the 12 months of periods going forward from time T, and we're going to use the daily data to try to figure out how does the stock co-move with the market. This is the usual unconditional market beta. And within this 12-month period, we're going to focus on 6 months of sample during which the market did relatively poorly. And we're going to again ask, how does the stock co-move with the market during this market declines? And that's going to be our measure of downside beta. Of course, one of the issues with downside beta is that this is very highly correlated with just the unconditional market beta. In fact, in our sample, I think the correlation is above 0.8. So Ang, Chen, and Xing in their 2006 paper make the argument that a more sensible measure of downside beta is to look at the relative downside beta, which is going to be just the raw downside beta minus the unconditional market risk. So this basically gives you changes in downside risk above and beyond that would be explained by unconditional market risk. In the paper, we also consider KOSKINEN and tail risk beta, which are typically considered as alternative measures of downside risk. I won't have time to discuss the details, but ultimately we're going to find results that are very similar regardless of which particular measure we choose to focus on. Okay, and we also, one of the main reasons we focus on KLD is because of the fact that it spans a longer period of history compared to other ESG ratings. And our downside risk measures typically require a long period of time to actually estimate and get a reasonably accurate estimates. So this long history of the data is a huge advantage for us. So we're going to focus mainly on, but the other thing that we also want to mention is in the early periods, KLD tend to focus on relatively large firms. So for the consistency of the data, what we're going to focus on in the main paper is focus on stocks that have market cap bigger than the median New York Stock Exchange size throughout the whole history from 1991 to 2016. But in the paper, we also consider as an alternative sample something, the whole universe of the stocks that are rated after 2003. Okay. So the first thing that we want to do here is do a portfolio sort analysis. So at the beginning of each month T, within a given industry, we're going to sort firms into 5 quintiles based on their past ES scores, keep track of the monthly holding period return. And for the risk measure, we're going to look at the risk measure computed from time T to T plus 11, just the way we described in the previous section. What we find is, doesn't really matter what kind of factor model you use or whether we equal weight or value weight. It's very difficult to find much of a significant difference between high ES firms and low ES firms in terms of their return. We also try like the Fama-French 5-factor model, adding the liquidity Pastor-Stambaugh liquidity factor. We played around a lot of factor models, but the evidence remains essentially the same. On the other hand, when you focus on the market beta, we do find that high ES firms tend to statistically significantly lower down market beta than the low ES portfolio. we repeat the analysis using our measures of downside risk. And across all the 4 measures that we consider, we find that high ES portfolios have a lower downside risk. Of course, with tail risk, it's not statistically significant. And with co-skewness, higher co-skewness actually corresponds to lower downside risk. So the sign is in the right direction. The last result that I want to share is, obviously, the portfolio sorts are not controlling for various factors that we know could be affecting the risk level of these firms. So we're going to run a Feynman-Macbeth regression, where we're going to try to run regressions of future realized risk measures over the next 12 months, or in the case of tail risk, over the next 5 years, on the ES scores, industry fixed effects, the past values of the risk measures, as well as the usual firm characteristics that we know might affect the risk level. What we find is the first 2 columns only introduce the size control and past realized risk measures. So this is controlling for the autocorrelation structure. The right-hand side is good. The last 2 columns are going to introduce the full list of controls that I just mentioned. And what you see is controlling for the autocorrelation of beta, the negative relation between beta and ES scores turn statistically insignificant. Whereas perhaps reassuringly, even though beta and downside beta are highly correlated, in the case of downside beta, the relation continues to be statistically significant. We repeat the analysis with our 3 measures of downside risk. Again, the first 3 columns only introduce the past values of risk measure as well as the size control. The last 3 columns introduce the whole list of controls. In all cases, we find a very robust, strong evidence that high ES scores predict a lower downside risk. And what I want to talk about now is interpreting the economic magnitude of these estimates. The way we do it is we imagine a firm that was ranked in the lowest 10% in terms of ES score, push it up into top 10%. In our database, this corresponds to about 1.05 point increase in ES score. And we're going to multiply this by the coefficient in front of the ES score in the regressions that we just saw. So typically what we find is for a 1.05 increase in ES scores, our estimates indicate a decrease in relative downside beta of about 0.017. To get a sense of what this number represents, this represents about 3% of the intradecimal range of the relative downside beta in our database, which seems to be quite modest, to be euphemistic. And if we were to compute the risk premium-based compensation that's implied by this is about a 0.2% per annum increase compensation in expected returns, which again seem to be quite small. Same conclusions can hold whether we use co-skewness or tail risk. There are a few explanations for why this might be true. The most natural one is the measuring error, so the attenuation bias. We know that ESG ratings of leading agencies tend to disagree quite substantially. There are some papers on these. So that to the extent that we're relying only on KLD ratings, these coefficient estimates that we get might suffer from very severe attenuation bias. So we did a few back of the envelope calculation to see just how much of KLD must be junk in order for our results, which seem economically small, to actually be economically significant. And
you're into your last minute there, John.
Okay, thank you. It seems that we require it to be about 97% of the variation must be noise, which seems implausibly too much. And we also repeat the analysis with sustained analytics ratings. We find very similar, if not slightly weaker results. So I'm going to conclude here. We try to ask, can we justify ES investing based on risk return considerations? Our conclusion is you cannot argue for, but you cannot argue against. So given that there's no pecuniary relation between implications of ES, it's not surprising that we see the significant growth of this industry with a lot of non-pecuniary benefits that investors would actually get out of this. So thank you very much, and I look forward to the discussion.
Okay, thank you very much, John. We're now going to go to Yrjo Koskinen, zooming in from Calgary, Alberta.
Thank you, Michael. And let me share my. Can you share my screen? Can you see my screen now?
Yes, I can.
Thank you so much. So congratulations, John. Very excellent presentation. Very, very clear. It's a pleasure to hear you explain the paper. Now I finally understand it. I'm just kidding. So let me quickly summarize the paper, and I don't want to spend too much time on this because John did just a good job. So this paper shows that when you short portfolios to quintiles based on the ES ratings, so not ESG, dropping out the G, but ES ratings, they don't have excess, statistically significant excess returns to alphas, or between highest ES portfolio and lowest ES portfolio. In one specification, high ES portfolios have lower beta, but John explained this is not really a robust relationship. Then the paper continues with Fommenbach-Brent's firm level regressions on monthly data and provides evidence that the different measures of downside risk, like downside risk, beta, relative downside beta, KOSKINEN, tail risk, are negatively related to lagged ES scores. So KOSKINEN is actually positively related to lagged ES scores. Effects are small economically. I'm not so sure how robust this is because there's an errors variable problem, and as John mentioned, attenuation bias. So perhaps we shouldn't look at that much of the economic significance, but still, there's no evidence that this would be a major issue. So, and then finally, the results that I also found very interesting is that the partial explanation for downside protection or less downside risk is that institutional investors hold on to the ES stocks when markets face a severe negative shock. I thought that was a very interesting result. So let me just give a brief assessment, and then I'll have some comments. So of course, the risk and return of ES investments is a very important topic, not only in academia, but also in practical asset management. We know that all asset managements like to brag about that our ES investments or ESG investments generate positive alpha, and that's quite often the marketing is dishonest, that even if some periods the realized returns have been extraordinarily high, doesn't mean by any logic that the expected returns should be high. So there's a lot of dishonest marketing going on, and it's no surprise. This is a big business by now. So this is in practical sense, it's a very important topic, and also, of course, great interest to academics. Excess returns, like John mentioned, or alphas, have been studied a lot with mixed results. You know, positive alphas, zero alphas, negative alphas, depending on the time period, depending on who the start. So there's no robust relationship. I just picked one recent paper, not necessarily because this is really a great paper, because it has a great title. So from 3 guys from edX, the systematic beta practical side, wrote a paper showing how I shrunk the ESG alpha. So that whenever people show positive alphas, it's not really robust. So we know that the alphas are all over the place. Perhaps a fair assessment right now, it should be a 0, maybe going forward, might be even negative. But I don't think there's much, I mean, that's a very crowded literature by now. But of course, the main contribution relates to the risk measures in this paper, especially the downside ones. But of course, this paper is not the first paper to study these issues. And what I've seen, I mean, of course, the paper is very interesting, very topical. At least the version I read is still a little bit rough on the edges, and an early version, so needs considerable work to be submittable to a top journal. So let me say that this is not the first papers to study relationship between ES ratings and beta. So John and his co-authors mentioned in their paper that Rui Albuquerque, myself, and Jeong, that we have a theory paper on ESG and beta based on the idea that, okay, consumers are more loyal to ESG firms, and that creates systematic risk that is less for ESG firms. But they fail to mention that actually we also have an empirical part in that paper. So it's not only just a theory paper, it's also theory plus empirical paper, where we show that ES scores and beta are negatively related when we interact ES scores with advertising. So firms that advertise a lot and have high ES scores have also low betas. So I think you should better relate to the existing literature. Just as mentioned, there's this theory paper without any mentioning at all about that we have empirical evidence there. And I don't mind at all if you refute our empirical evidence. This is the way science progresses, and I mean more citations for me. I don't have a dog in the fight. I just want to know, okay, is there really a relationship between ES scores and betas? So I think you should really kind of try to relate. So we use annual data for beta regressions. You guys use monthly data. So they're a little bit different. Different methods. So I don't know. It would be nice to see how robust the beta ESG relationship really is. And of course, we know that there are also prior studies on ES ratings and downside risk. And you mentioned both of these papers and maybe the different ES, because I picked up the latest versions. So Höppner, Oikonomou, Southner, and Starks and Zhou show that ESG investor engagement reduces downside risks. But they use different measures for downside risk. Lower partial moment, which means distribution of returns of less than 0%, and more standard value at risk. So again, although they use different measures, it would be nice to have a discussion how your findings relate to Höppner et al. Paper. And same thing with the Ilhan, Southner, and Wilco paper, although it uses data from option prices. It also talks about tail risk. So again, discuss how consistent or inconsistent your results are with the Ilhan et al. Paper. So in a sense, you have to be very clear, say, what is your contribution? So you're not the first ones to look at beta, not the first ones to look at downside risks. So is your contribution that you look at the different measures of downside risk, just showing that, oh, okay, Höppner et al. is robust results. So you really think about, okay, where do we contribute? Or one of your results could be that they're refuting my paper, which would be also a nice result to have. One thing that you mentioned, and is in terms of the erosive variable and attenuation bias, that ES ratings disagreements might create difficulties assessing the economic significance of your results. And I think that would be a worthwhile exercise to examine in general how ESG ratings disagreements would affect your results. So there's a nice theory paper with also some empirical results by Avramo et al. From this year. I think there was an earlier paper last year, but the current version is in 2021, where they first build the theory model and then they have some empirical results that ESG uncertainty or ESG disagreements affect risk-return trade-off for stocks. And the result is that ESG disagreements or uncertainty reduce demand for stocks, especially for ES-sensitive investors. And if there is a lot of ESG disagreement for a stock, there might be positive alpha or excess returns for those kind of stocks, because the demand for stocks is so low, because investors really don't understand. Is this a high ESG stock or low ESG stock? Then
last minute, Yrjo.
Okay, then there's also a very nice empirical paper by Gibson, Brandon, Gruger, and Smith, showing that stock returns are positively related to ESG disagreements. So maybe you could look at how ESG disagreements affect your results, beta results, and downside risk measures. Finally, last slide, and then I'm done. And I'm happy to send you all my slides. So I really like the idea about looking at institutional investor preferences, and that be a partial explanation for your results. We just came out with a working paper, I think last week, using Morningstar data, monthly data, during the COVID-19 crisis of 2020, showing that ESG funds reduced net sales during the COVID-19 crisis. And of course, to the extent that ESG funds actually invest more in ESG stocks, that would show that ESG stocks will be more resilient in a crisis. And then we also look at the stock level evidence. And we find that, for example, funds experiencing inflows, which were mainly ESG funds, actually helped to stabilize the market. And interestingly, when both ESG and non-ESG funds experiences outflows, they sold more of their non-ESG stocks and hang on to the ESG stocks. So not only the ESG funds help to stabilize the market, but the non-ESG funds tended to stick to their ESG stocks and sell their non-ESG stocks. I'm done. So, John, excellent presentation, and happy to send you the slides.
Okay, thank you very much, Yrjo. John, would you like to take a question from Vikas, or would you like to respond?
I'd like to take question. Thank you, Yrjo, for the comments. I'd love to hear Vikas comment first.
Okay, go ahead, Vikas.
Thank you very much. So very good paper, John. So my comment has to do with your conclusions. You had a binary sort of choice there, that either investors are out for returns, and if there aren't any returns, then there must be non-pecuniary benefits. And I think that the third possibility is that investor judgment is driven not by reason, but by affect. And there's some experimental evidence supporting this in this Journal of Finance paper by Hartsmark and Sussman, where they survey MBA students from the University of Chicago, admittedly one of the better places for finance in the world. And these MBA students, when asked why you invest in ESG high 5 globe companies, their answer was they expect higher returns. And then when asked, well, the higher returns, does it mean that these companies have more risk? They came up with the answer, no, 5 globe companies have lower risk. Now you figure it out, higher returns and lower risk. If this is not affect, I don't know what affect is. So there's clearly a third possibility here, John.
Yes, absolutely. I should mention that I'm aware of this, so it's my fault. I should have also considered that possibility. So thank you for pointing that out. Can I respond to your?
Yep, you've got 2 minutes. Go ahead. Go ahead, John.
Yeah. So thanks a lot for all the great comments. Regarding the empirical results in your paper with Albuquerque and Zhang, of course I'm aware of its existence. And we actually do refer to this when we talk about the beta results that we have in the results section. It's just that I think in the introduction, we thought like the main contribution was related to the theory, and we thought that our results in terms of systematic risk relates nicely to that paper. That's why we focused that in the way we wrote the literature review. Regarding the Hopner and his co-authors papers and the Ilhan et al., we've definitely received a lot of questions about this. Short one sentence answer is, I think we're the ones that are looking at the systematic downside risk. So they look at the, let's say, the value at risk, lower partial moments. We actually did also look at this at some point. It's just that we became aware of these existing papers, and we wanted to see, you know, to the extent that systematic risk might be more relevant for portfolio choice, we wanted to stick with the focus with the systematic risk component. And that way it relates closer to Albuquerque, Koskinen, and Zhang paper in that sense. But we'll try to emphasize the empirical results as well in a more clear manner, as well as trying to relate to these two papers in a clearer way. And the last thing is, we did think about the disagreement and how that might affect it. We thought it might make the paper simply too fat, so we left it out for now. But we might actually think about this and maybe put this into appendix. So we'll think harder about it. Thank you very much.
Okay, great. Thank you, John. I guess key takeaway is that, like you said, buying stocks of high ESG firms is not bad for your portfolio. So, you know, there's still, you're not having to give up something. Okay, with that, we're going over to Aaron Yoon in Chicago, not at that other lower rated school, but at Northwestern. Aaron, over to you.
Yep, thank you, Mike. You can see my slides, right? So, you know, thank you, everyone. And I wanted to thank Aymen for spending his precious time, you know, reading, and I really look forward to Aymen's comments pretty soon. This is joint work with George SERAFEIM at HBS, and this paper is titled as I think it was a nice transition from sort of you know, ESG rating disagreement. It's titled Stock Price Reactions to ESG News: The Role of ESG Rating and Disagreement. So motivation is super simple, right? I mean, we have ESG sessions and all these conferences these days, and everyone is very, very interested in ESG. And if you look at the real world, you know, this ESG took off, right? In 2019 summer, you know, BRT 200, you know, that represents the CEOs of, you know, very large US companies, came out and redefined the role of companies. And from an investor's perspective, you know, there's this initiative that's very often cited, the UNPRI initiative, and their AUM, that, you know, those money that signed to commit on ESG issues altogether exceeded $120 trillion. That's like 3 times entire US market cap. So this is no joke, right? So essentially everyone's cousin is interested in ESG. And, you know, here arises ESG ratings, a newer set of performance evaluation mechanisms, right, on ESG issues. And, you know, I find ESG ratings to be super fascinating because 10-some years ago, when I was a sales trader on Wall Street in Hong Kong, when I called client investors, you know, like big asset managers, their criticism on Wall Street was you add no value because your EPS forecasts are so next to each other. You can't distinguish between the Goldman Sachs and the Deutsche Bank analyst. And then here comes ESG ratings, and they're like, oh my God, it's so hard to verify. They're all over the place. You know, they're multidimensional. It's so difficult, but we still have to charge clients high fee. That's sort of the state of the world that we live in right now, right? So this paper at the very conceptual level is a response to such response to ESG ratings. How do you judge the quality of ESG ratings, and how can we help asset managers sort of take advantage of this disagreement, which is a very descriptive phenomenon right now in this ESG space? So it's, you know, just one attempt, and I'm aware, you know, I mean, previous, you know, presentations talked about a bunch of papers in, you know, on ESG and the ratings disagreement. So this paper is essentially sort of, you know, a small step towards better understanding that. Specifically, we ask 3 research questions. First question is, do ESG ratings, so these new performance mechanisms, predict future ESG news? So in this paper, we're essentially using ESG news, future ESG news, as an outcome variable. And how does the disagreement among the raters affect this predictability? Second question is, how do consensus ESG rating and disagreement affect stock price reactions around ESG news? And is there a predictive power of these ratings on future stock returns? So with this in mind, you know, we sort of wanted to sort of build our attention, right? You know, some people might say that, of course, ESG ratings should predict future ESG news, but we believe that, you know, the answer is unclear because, you know, recent academic papers pointed out that, you know, they're everywhere. So which one to use, we don't really have an agreement on. And the old SEC chairman pointed out that, oh, ESG ratings are essentially useless. They're very noisy, and we're not sure what to do with them. Summary of finding, what we do is our innovation of this paper is that we use this ESG news data that is a firm day level data that's it was called True Value Labs, but now it's been purchased by FactSet. So it's being provided by FactSet, and it essentially captures ESG sentiment score, and it ranges from 0 to 100. 50 being neutral, 0 most negative, 100 most positive. And score changes when there is new news. And for our ESG ratings, which we use on our X as our key independent variable, we use ESG ratings from MSCI, the IBA rating, Sustainalytics, and Thomson, and we make it to range from 0 to 100. You know, some of them ranges from 0 to 10, so we just multiply 10. What we find is that ESG ratings do indeed predict future ESG news, but that the disagreement among the three major vendors hinders the incorporation of ESG information into prices. And interestingly, and actually potentially quite obvious, different raters have differential predictive ability. And we use actually this feature to predict future stock returns, a small exercise. You know, where we view our paper, there's a bunch of papers now on ESG ratings disagreement, and we tie this to ESG ratings ability to predict future ESG news. No one's really looked at what the outcome variable should be, and we acknowledge that there could be multiple outcomes, and also that ESG news may not be the most appropriate outcome, but we're taking a step towards understanding whether ESG ratings fruit to a future ESG outcome, just like analyst forecasts fruit to EPS, you know, realizations, or bond ratings to, you know, bankruptcy, for example. You know, there's other papers that's already been mentioned here in previous presentations, you know, by, for example, Philip. We also sort of highlight the role of ESG rating and disagreement and tie it with market reactions to ESG news. And also the last part, I'll save it for last because I feel like it's a nice sort of, you know, fun toy exercise. So our sample ranges from 2010 to 2018, and we're working with roughly 30,000 firm day observation across different GICS industry. And, you know, I mean, you know, we use pretty standard controls, and we have, you know, industry adjusted stock returns, ESG news, and these ESG ratings construct and disagreement. You know, we confirm prior literature, like, for example, Berg et al., Roberto's paper with Florian and Julian, confirming that ESG ratings by different vendors do indeed exhibit not as high correlation as, you know, 0.999. You know, so not all of them are quite correlated. So to give you a quick glimpse of how we answer our first research question, this is what we do. So we have ESG news of day T on our Y, and then we have our normalized average ESG rating of T-1, which is the latest ESG ratings, and see whether that predicts future ESG news, which we do find. And then we find that we also have a disagreement construct between the three major vendors. And we find that this predictability decreases when there are disagreements. We also decompose disagreement. So we thank the authors of Berg et al. 2020 for sharing their data, and then they very interestingly point out what are drivers of disagreement. They divide into three things: weight, scope, and measurement in ESG ratings. And we find that differences in measurement is the driver of this particular phenomenon. Our second research question is, how do consensus ESG ratings, so the average ESG rating, right, and the disagreement affect stock price reactions around ESG news? So we do a quick 2x2 looking at market reactions. So our outcome variable is industry adjusted return around the 3 days of the news. You know, we have all ESG news, and we also separate ESG news that are identified to be financially material by SASB, which is a, you know, pretty typical practice these days, looking at materiality of ESG issues. And we divide the news into positive news, negative news. And then for those group that have high average ESG ratings and low average ESG ratings, and we find that there is more positive reaction to positive news when firms have low consensus ESG ratings. So there's that surprise element, but we don't find an asymmetric relationship for negative news. And we find that this sort of phenomena is much stronger for news that are identified as financially material by SASB. And we put this in essentially a multivariate format, and we confirmed the findings. I just want to highlight two things. We find that this stock price reaction spread between positive and negative news, so 75 basis points, gets moderated when there is high average consensus ESG ratings. And again, this gap widens for news that are identified to be financially material. Last question is, so if so, what? Are there any predictive abilities of these ratings on future returns, and what could we do to sort of identify that link, right? So that's our third research question. So what we do is the following. So we break down the average ESG rating construct to the three vendors, right? MSCI, Sustainalytics, and Thomson. And we find that MSCI has the most predictive power, and then followed by Sustainalytics and Thomson. But Aymen probably noticed that we didn't highlight this result much in the abstract and intro, and the reason is very simple actually. Sustainalytics shared data with us for free, and then we had to pay for MSCI and Thomson, and then we were sort of hoping for results on Sustainalytics to hold, and we would sort of return the favor, but then what do you do, right? So we're sort of just a fun story. So what we do is the following. So we do just a quick exercise, creating portfolios using this signal. So we restrict our sample to those observations when there's a lot of disagreement. And then our long portfolio, so we create a long short mimicking a hedge fund. Our long portfolio is when MSCI, which is the most predictive rating, indicates a buy, and then mechanically the rest would indicate a sell, right? So that's our long portfolio. So essentially follow MSCI when they indicate a buy, just the opposite for short. So when MSCI is indicating a sell, mechanically in the high disagreement sample, the other two raters will indicate a buy. So again, follow MSCI here. And we form portfolios from Jan of T+1 and then hold it for a year. And the typical equal weighted value weighted approach, and controlling for the latest FAMA French, I think 5 factors. What we do is, we have monthly stock returns, right? And we hold it for a year, and we rebalance it every year for 8 years. And we find that this long short portfolio generates roughly about 4% alpha. So, like I sort of briefly mentioned in passing, there are asset managers who are struggling, right, to understand and how to make sense of this disagreement. And what we're proposing is that, okay, if there is a disagreement, one potential strategy that you can consider is to follow the most predictive rating. Predictive rating meaning that rating that predicts future news the best. We hold the sample for 24 months. So hold our portfolio for 24 months. We find the annualized alpha to go up a little bit actually. And only after holding it for 36 months, we find that the T-stat goes down. And what we're doing is, what we're sort of viewing this result is that it essentially takes about 3 years for this information on ratings to be integrated and disagreement to be fully resolved. So that's all we have. We find that ESG ratings predict future ESG news. And we believe that this was a pertinent question when we started the paper, because no one's really trying to assess the validity of ESG ratings into a sort of a future outcome. And we find that, yes, there is disagreement, and it moderates this relationship, this predictive ability, and how ESG news gets impounded into stock prices, but also with the caveat that maybe we can use disagreement to our advantage and to use it to predict future stock returns. So thank you very much.
Thank you very much, Aaron. And we'll now hear from the discussant, Aymen KAROUI. And Aymen actually on his resume has Sustainalytics. So we'll see if there's a spirited defense of their rating system.
Yes, thank you so much, Aaron, for the nice presentation. Thank you, Michael, and big thank for the organizer also of the nice conference. Yes, I think this is definitely nice paper that addresses so many aspects of the ESG. So then I will start with summarizing the paper and then move on with more details and more specific comments. So the paper is from SERAFEIM and Aaron and myself from Sustainalytics and Morningstar, and the usual disclaimer must apply. Of course, the views here do not express or do not represent Morningstar or Sustainalytics. So the research question is very straightforward. So the authors investigate whether ESG ratings predict future ESG news and the associated market reaction. So in a sense, we have this triangular relationship between these three, how ESG ratings are useful, and they show partly they are useful because we can predict ESG news. And also it seems that some investors under some conditions like whether there is disagreement or no disagreements between raters, then there is somehow more or less response with regards to ESG ratings. So using this almost 30,000 unique firm day observation over a quite long period between 2010 2018, I think there is the first main result is that consensus rating predicts future news. But this relationship, of course, is conditional on the fact whether there is a disagreement or agreement between the three considered data provider or rating providers. Next, we also find a significant relationship between news and market reaction. So market is really sensitive to ESG news, and they do respond consequently. So in terms of expected return or risk-adjusted return. And also this relationship itself is moderated by whether there is a consensus in ratings or not. So this is why the paper is really about this triangular relationship between ESG rating, ESG news, and also this whether there is a consensus disagreement or no disagreement. So overall, I think there is evidence that ESG rating predict future news and proxy for market expectation of future news. Now I provide some general comments. I think this is really a pleasure to read the paper. It is extremely well written. I think addresses for sure an interesting question. Also, if there are some PhD students here listening to this session, I think I would advise them to have a look at the paper. It's really clear. Even if you're tired, you can understand the paper. So that means that the authors really did their job. Writing the paper quite clearly. Now, also it brings an important contribution to the literature that examine the property of ESG ratings and market and investor reaction to ESG news. This is pretty clear also from the first lines when you read the paper, even from the abstract. Now it presents also, as Aaron mentioned, the very unique results, very new result in comparison to literature on disagreement, on ESG ratings and everything. So very interesting perspective and very interesting insights. So also it includes an interesting appendix. So that includes several robustness tests and alternative specification. So now in my view, what must be done has been done. So what I'm providing here are only comments on the sites and sometimes on the side of the site. So this is probably something that you can have a look at and see if there are things that you can pursue or not. So the first thing that came to my mind when I read the paper, okay, you look at ESG news, ESG ratings, then is there a way to categorize that? Are investors more sensitive to the environmental part or environmental dimension than to the social dimension, for example? And what type of investment are sensitive to which dimension? I think something that would add more comprehensiveness to the picture. Another thing that came to my mind, okay, you choose three different rating providers or four, I think. Rating provider, and the way you compute that is you took out the three ratings and you compute the standard deviation. But the standard deviation of three observation, I think we can do something better, or we can do something different. So perhaps replace row scores with categorical quartile variable, look at the sum of absolute differences, look at other different measures than simply having this standard deviation based on three observations. Now the other thing, why the disagreement? Well, I was looking at the correlation paper and I couldn't find an answer, a straightforward answer. Perhaps also in my comments I have more questions than answers. So why disagreement is highly correlated with ESG ratings? I could not understand that. And then interestingly also, it is highly correlated with one, mildly correlated with another one, and negatively but strongly correlated with the three ones. So if you look at Disagreement, it has a different response with respect to each of these considered ratings. Although the three ratings considered altogether, they are positively and strongly correlated, as you mentioned in the presentation. Now, another theoretical point I was thinking about when I read the paper, is there an overlap actually between ESG news and ESG ratings? Are they really separate? Because the thing is that some information that is reported in ESG rating might actually come from ESG news. So they find, for example, company disclosure, there are some news, sometimes the information is missing. Where am I collecting this information? Oh, I will look at something that is publicly available. And vice versa, conversely, some news also are based on ESG rating disclosure. So you have some disclosure of new information. Oh, I might write something on Amazon, I might write something on Microsoft because this is a timely subject and there is a new information that is coming to the market. So then there might be some relationship between the two and somehow some overlap between the two. And this is why also we find this high and positive correlation between ESG ratings and news. Another point that I was thinking about is averaging ESG rating. So what you consider three rating providers, and then what you do is simply take the average of these three. And I was thinking about that because we talk a lot about the disagreement because of the fact that we have different ratings providers, and these rating providers do not agree or do not bring the same. So how can we move a step forward? How can we solve this disagreement? And perhaps this is something I found worth it. So why not then could be the standard that we take the average of these three. The good thing in the paper that when you take the average of these three, it is still highly and consistently correlated with each of the three measures. So it is really still consistent with everyone. So no one would be angry in a sense. All your data providers, including Sustainalytics, will still be happy. But at the same time, you somehow aggregate more information. So you aggregate different view and you have somehow a meta ESG rating. So I was thinking about that. Perhaps this might be somehow some way to address this disagreement. Also, another thing, there is also high correlation with the size, I think, with the disagreement, but also with the ESG rating. But I was also confused somehow. Is more information, is it something good or bad? Should we have more disagreement or less disagreement in case we have more information available? Now, some very, very minor comments here and there. So I think in the equation, we still need to control for past ESG news in the equation. Also, I think ESG rating themselves could be also adjusted with respect to industry or sector, just to remove the average ESG rating. As you did for return side, you can do that for the rating themselves. Also for the return, we can consider simply as a robustness check. You control with respect to the equity market and look at the risk-adjusted return measure instead of only taking return that are adjusted with respect to the industry index. Also, since this is an event study, I was thinking about having a graph with the cumulative abnormal return and displaying that. Perhaps that would give us, a broader picture, and you have really a clear when it starts that reaction and when it ends. And also any possibility to include investor sentiment or analyst forecasting as additional control variable, because we know that investor sentiment might also come into play when we have all this news and everything. Finally, we discussed that in the paper, but I didn't find the T-stat or standard deviation for the univariate results. Perhaps that would add more substance or more arguments to the discussion, and also perhaps report the differences so we can see differences between high and low disagreement. Finally, also instead of looking at average ratings, perhaps also sometimes look at the mean, most conservative, the max, also, and see how robust are these results. So overall, I think this is a really nice paper. It was really it was a really big pleasure reading the paper. I learned a lot of things in reading the paper. Again, the comments I provided are really something on the side of something perhaps the author could use, but overall, I think the message is there, and I would like to thank the authors for all their efforts. Thank you.
Okay, thank you very much, Aymen. I'm going to open it up to Aaron to respond and look for questions.
Yeah. Can I just respond really quickly? So Aymen,
Please.
thank you very much. It's, you're very thoughtful, your comments, and I could see that, you spend a lot of time, so thank you very much. Let me just sort of, I agree with essentially all the comments that you made. And, I think it's a good point, right? Where is it coming from? E, S, and G, right? And I think one thing that's really nice about this FactSet True Value Labs data is that they break the topics down into the SASB, 5 big topics like business innovation, social capital, human capital, natural capital, and something else I forgot. So I think it's worth sort of exploring where that effect is coming from. Especially, I think it could be a pretty informative exercise. And the overlap on ESG news and ESG rating is a very good point, right? Because I think, Sustainalytics, you also measure controversies, right? So, how tied is it, right? I think it's a very interesting question to explore. And I'll be interested to know because I'm quite certain that MSCI IVA ratings don't look at news, right? But Sustainalytics do. So some of these differences, right? Teasing it out, whether to use ESG news as a input, right, is something that I think obviously is correlated to firm type and ESG ratings, but also an informative exercise. And so I think I should have given the prior literature a bit more credit when I was presenting. So a recent paper by Christensen et al. That looks at ESG ratings disagreement and disclosure. They document that the more disclosure you have, interestingly, the more disagreement you have as well, which is what we find. So, at least for this ESG space, it seems like, more information could be potentially too confusing. But hopefully as time goes on, right, this will be resolved as well. And, point well taken on ESG ratings, a sector adjustment. We do control for industry fixed effects, but I don't think it'll do the job. So as we can make it congruent as the industry adjusted return, I think it'd be nice. I know that MSCI, they have a sector adjusted score as well. So maybe we can try that as well for a robustness test. And the analyst, forecast, as a control, that comment, I very well, taken. We've removed those. So similar in spirit, we tried removing in the new version the firm days around earnings announcement where there's a lot of analysts forecasts and etc. And the results stay pretty much the same. And I really actually like the min and max argument because the issue with this whole ESG space is that even when I know you have a paper with Sadok on the mutual fund, right? But a lot of people look at evaluated ESG scores. I have a recent paper on UNPRI and assessing their ESG performance, and the key issue there is that you're washing out and you're taking the average effect, right? So some ESG, you should really look at the top or the bottom, for example, on different dimensions to really give credit to potentially negative screening or the top performers. So overall, thank you very much. These are just very, very excellent comments. Thank you. Yeah.
Okay, great. Other questions? Or Aymen, did you want to respond? No?
Well, nothing to never answer. Thank you so much. Thank you.
Okay. I had a question, and this is shows my lack of familiarity with the ESG literature. Has anyone ever done just a horse race of MSCI versus Sustainalytics and the others to see if a long-short strategy with MSCI is better than the other two, or is it really disagreement that matters?
So I'm sure Aymen tried it. I have a paper with Kyle Welch that looks at that uses Glassdoor as a signal for employee satisfaction and a proxy for CEO ability, and doing like double sorts with MSCI and different ESG ratings. And to tell you the truth, none of the ESG scores, when you create a long short, generates positive stock returns. That sort of doesn't necessarily say that they're bad, but what is ESG rating intend to capture, right? Because some people may focus on alpha, but some ESG ratings may focus on whatchamacallit, the overall stakeholder, welfare and everything. What I found interesting is that though MSCI ESG rating has a materiality twist, but it still doesn't generate long short alpha. It could have two explanations. I think one is, it's already priced away, or there is measurement error. I think those are all sort of empirical questions that we can all sort of think about.
Okay, great. Well, this brings our session to the end, but I wanted to highlight that we have upcoming after our lunch break. Notice our lunch break is over the next hour. We have a great roundtable discussion featuring clean tech with a lot of excellent speakers. If you've not already registered, you can register at this link here on the program, and we look forward to seeing you join us in 1 hour at this website. Okay. Thank you very much, everyone. That's it. Enjoy your lunch. Basma, anything over to you? Final word? Nope. Okay. Great presentation. I know so much more about ESG ratings, and I have just so much less confidence in them than I did an hour ago. And Aleksandra, I know you wanted to ask Aymen about Sustainalytics, but he only just joined. He was not there, Aymen, right, for the change. I saw on your LinkedIn that it was in the month of August you joined.
Yeah, exactly. Yeah, I didn't join at the beginning yet.
Yep. So he's gone from academia to the dark side. So congratulations and good luck on that career choice. Okay. Okay. See everybody in 1 hour. And there's a separate link from this main link from if you want to join that clean tech seminar. Okay.